Oil reaching $100 per barrel is one of those moments that quietly sends signals through the entire financial system. For most people, it simply means higher gasoline prices, more expensive transportation, and possibly rising costs for everyday goods. But for investors and institutions, oil moving into triple-digit territory often signals something much larger happening beneath the surface of the global economy. Energy prices sit at the center of modern economic activity, which means changes in oil prices can influence inflation, currencies, central bank decisions, and eventually the behavior of other commodities like gold and silver. Because of that, when oil approaches $100, financial markets begin paying attention very quickly. I'm Alex, and in this video, we're going to break down what usually happens when oil reaches $100, why this level has historically been important for the global economy, and what it could mean for gold and silver in the months ahead. So, stay with me. To understand why oil matters so much, it helps to recognize that energy is one of the most important inputs in the entire economic system. Transportation networks, manufacturing, agriculture, shipping, and even digital infrastructure all rely heavily on energy. When oil becomes significantly more expensive, those costs eventually ripple through the supply chain. Companies pay more for transportation and production, which slowly pushes prices higher for consumers. This is why oil is closely tied to inflation expectations. When oil prices climb toward $100, investors often begin asking an important question. Will inflation remain higher for longer than central banks expect? If energy prices stay elevated for an extended period of time, inflation can become more persistent because businesses continue passing higher costs through the economy. That shift in expectations can quickly influence financial markets. Bond yields may rise, currencies may adjust, and investors begin repositioning portfolios based on the possibility that inflation will remain stubborn. This is where gold often enters the conversation. Gold has historically functioned as a store of value during periods when inflation weakens the purchasing power of currencies. When inflation expectations increase, investors often allocate part of their portfolios to precious metals as a hedge against monetary instability. But the relationship between oil and gold goes deeper than just inflation psychology. Energy and precious metals often move together during broader commodity cycles. When global demand is strong, multiple commodity markets tend to rise simultaneously. Oil, copper, industrial metals, and precious metals can all benefit from the same underlying economic forces. This is why commodity investors sometimes describe these movements as super cycles. During these cycles, rising resource demand and limited supply can push multiple commodities higher over extended periods of time. Gold can benefit from these environments not only because of inflation concerns, but also because commodities as a group attract capital. Institutional investors sometimes increase allocations to commodity sectors when inflation risks grow. In those cases, gold becomes part of a broader hard asset strategy rather than simply a defensive position. But silver introduces another layer to this story. Unlike gold, which is primarily influenced by monetary demand, silver also plays an important role in industrial production. Electronics, solar panels, advanced manufacturing, and various technological components rely heavily on silver. Because of that, silver often behaves differently depending on the reason oil prices are rising. If oil reaches $100 because global economic demand remains strong, silver may benefit from both industrial demand and rising investor interest in commodities. In these situations, silver sometimes outperforms gold because it participates in multiple economic narratives at once. It acts as both an industrial metal and a monetary metal. However, the situation becomes more complicated when oil prices rise due to supply disruptions or geopolitical tension rather than strong demand. For example, conflicts in major oil-producing regions or unexpected supply shortages can push oil prices higher even when the global economy is slowing. In those environments, gold often reacts first. Investors view gold as a safe haven asset during periods of geopolitical uncertainty. Capital tends to flow into gold when financial markets become unstable or when investors begin seeking protection against risk. Silver may still benefit, but sometimes with a delay because part of its demand depends on industrial activity. This dynamic is why experienced investors often watch the gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold. When uncertainty dominates financial markets, gold tends to outperform silver and the ratio rises. If the price increase reflects strong global demand, silver may perform exceptionally well. If the increase reflects geopolitical instability, gold may lead the move initially. Institutional investors typically analyze these situations through macroeconomic frameworks. They ask how energy prices influence inflation expectations, interest rates, currency strength, and long-term portfolio allocation. Retail investors, on the other hand, often respond primarily to headlines. If oil spikes suddenly, short-term speculation often increases across commodity markets. But institutions usually focus more on the structural implications of rising energy prices. One of the most important structural relationships involves currencies, particularly the US dollar. Gold and silver are priced globally in dollars. When the dollar weakens, commodities often become cheaper for international buyers. That can increase global demand for metals. If oil reaches $100 while the dollar weakens due to inflation concerns, precious metals could receive an additional boost. However, the opposite scenario is also possible. If central banks respond aggressively to rising inflation by tightening monetary policy, the dollar could strengthen. A stronger dollar can sometimes create short-term pressure on precious metals even when inflation remains elevated. This interaction between oil, inflation, interest rates, and currencies makes macroeconomic analysis complex. Markets rarely move based on a single factor. Instead, multiple forces interact at the same time. Energy prices influence inflation. Inflation influences central bank policy. Central bank policy influences currency strength. Currency strength influences commodity prices. Understanding how these forces interact helps explain why professional investors spend so much time analyzing macroeconomic relationships rather than focusing only on price movements. Another interesting factor that appears when oil rises sharply is the effect on commodity production costs. Mining operations require significant amounts of energy. Extracting metals from the ground, transporting raw materials, and processing ore all depend heavily on fuel and electricity. When oil prices rise significantly, the cost of producing gold and silver often rises as well. Higher production costs can eventually influence supply. Some mining projects that were profitable under lower energy prices may become less attractive when energy costs increase. Over time, this can slow supply growth. Commodity markets often respond strongly when supply growth slows, while demand remains stable or increases. Institutional commodity investors closely monitor these cost structures. They analyze how energy prices influence mining margins and long-term production levels. When supply growth becomes constrained, prices can remain elevated for longer periods. Another factor to consider is how rising oil prices influence government policy and fiscal decisions. Higher energy prices can increase revenues for oil-producing countries. Many of these countries manage large sovereign wealth funds that allocate capital across global assets. In some cases, part of those reserves are invested in gold as a way to diversify away from currency exposure. If oil revenues rise significantly, these capital flows can indirectly support gold demand. At the same time, higher energy costs can strain economies that rely heavily on imported oil. Countries facing rising energy bills may experience currency pressure, slower economic growth, or higher inflation. These conditions sometimes encourage investors in those regions to seek protection through precious metals. This global dynamic can create multiple layers of demand for gold and silver simultaneously, but markets rarely move in straight lines. Even during strong commodity cycles, gold and silver can experience periods of consolidation, volatility, or temporary declines. Financial markets constantly adjust to new economic data, central bank announcements, and geopolitical developments. Because of that, experienced investors often focus less on predicting exact price movements and more on understanding the broader environment shaping those movements. Oil reaching $100 does not guarantee that gold or silver will immediately surge. Instead, it signals that important macroeconomic forces may be shifting. If energy prices remain elevated and inflation pressures increase, precious metals may benefit. If oil prices quickly fall back due to increased supply or weakening demand, the impact on metals could be more limited. The key point is that oil prices often act as an early signal of broader economic conditions. Energy sits at the foundation of global production. When energy costs rise sharply, the ripple effects can eventually reach currencies, bonds, commodities, and equity markets. Gold and silver often become part of that larger story because they represent tangible assets within the financial system. During periods when investors become concerned about inflation, currency stability, or geopolitical risk, precious metals frequently attract attention. Oil reaching $100 is therefore not just an energy story. It is a macroeconomic signal. It suggests that inflation pressures may be changing. It suggests that commodity markets may be entering a new phase. And it suggests that the balance between currencies, interest rates, and hard assets may be shifting. When those shifts begin appearing, gold and silver are almost always part of the conversation that follows. Subscribe for more.